This is Victor, and I'm doing the video based on your illustrations and some other interesting information. I've got 4 illustrations to go over with you. This is the first one that's going to be showing your contributions of $20,000 a year for, and I just ran this to year 70 for 16 years on you, Mark. $20,000 a year. The first thing I want you to notice is we have a MEC limit of $38,000 and some change. That's a modified endowment contract limit. We can't put any more than this amount here into the policy, otherwise we'll lose the tax benefits. We don't want to do that. But it gives you an extra $18,000 a year beyond this $20,000 to contribute to the policy if you want to. Now, if you get to a point that you can contribute more, you would just open another policy. We call it opening a new branch to your bank, and of course you could do that on Tandy's Life if you want later on. But anyway, that's $20,000 a year with a MEC limit of $38,107. You see that your first year is going to provide you with a death benefit of $587,230. Net cash value column, your first year you drop into $20,000, you will have $16,205 from which to borrow from, and you can see how the cash value jumps up every year while you're putting the $20,000 in. This is your dividends coming out. Of course, you get dividends and interest, but this is the amount of dividends you're earning. You get down to your latter years, those dividends can get quite substantial, $19,000, $20,000, $30,000, depending on how old you are a year. You will see that right here, the vast majority of the money, $16,000, is going into paid up additions riders, which is the most powerful part of your cash accumulation. Of course, you get regular interest as well. So that's the difference between an infinite banking policy and the traditional whole life, whereas the whole $20,000 would be going towards death benefit. You would be getting, your dividends would be a lot lower, your paid up additions would be very low, and you just wouldn't have the accumulation like you see right here. Over here, monthly just breaks it down if you were to want to pay this on a monthly basis, but you're going to be annualizing it, $20,000. If you paid a monthly basis, it would come out to a little bit more, $20,880. You get here to year 16. You've contributed $320,000. You have $422,450 in cash. Your death benefit is at $706,000 by that time. Now, after that, we go reduce paid up. That means no more costs coming out. Your death benefit drops from $706 to $678, and then it starts going back up again a little bit because you're drawing income at this point. You'll be able to draw $22,533,000. Now, this is based on the dividend rate never going up, and with interest rates going up now over the next few years, I expect the dividend rate to be going back up again. Its dividend rate for Mass Mutual is 6.4%, which is the highest in the industry at this time. Now, there's some very important items here that I want you to remember, and I want to key on. $22,533. You're ending up here in year 16 with $422,000. $22,533 is about 5.3 and some change withdrawal rate. Now, if you have a 401k or an IRA, some kind of retirement plan like that, all the experts are saying, and there's a little bit of debate, but when you get to retirement, you shouldn't draw any more than 4% out of that retirement account. And you still need to be in the market. Because if you have all your retirement money in bonds, you're lucky if you're going to get 2 or 3%. That's not going to last for the rest of your life. I mean, you'd have to draw 1 or 2% hopefully to stay ahead of the game. Some experts are saying now 3%. So just let's be on the high side and say 4%. Well, here you're looking at a 5.3% withdrawal rate. Very high from retirement money. We're going to call this cash value by the time you hit 70 retirement money if you want to start drawing it out. And remember, this figure is all tax-free. You'd have to draw about $25,000 out of an account, or maybe more depending on your tax bracket, maybe $26,000, to end up to this level tax-free or after tax net. If you take this out to age 95, you've got 5, 10, 15, 20, 25 years of income at 22,533. That's a payout of, let's see, $563,325. That's pretty good considering you started with $422,450. Now let's put this in perspective with the conventional thinking. What if you put $20,000 a year for 16 years, right? 16 years here, in the stock market? Well, I used to be securities licensed. I used to manage money, do mutual funds, all that stuff. I gave that all up because it's just a racket anymore. But if you went with your typical financial advisor license for fees, and nowadays you see these commercials, stay away from the commission guys. Do business with me, and I just collect a fee, and if you do well, I do well, and if you don't do well, I lose money. You know, I get a cut in income. Well, that's fine to say, but it's really not completely honest. Because you'll pay an average of 1.5% to that advisor to manage your money, and he's really not managing it because he puts it with third-party companies, certified financial analysts working for these companies that do the day-to-day trading. Your financial advisor doesn't do any trading. You know, he advises you, he'll find some place to put your money, and he'll put it with these guys, he'll collect his fee, and if it's 1.5% and it's a $100,000 account, he's going to get his, over $1,000, the $1,500 if he's on a 1.5%, and if your account goes up to 105,000, he's going to get, his 1.5% based on 105,000. And if your account goes down, he's still going to collect his fee. But what they don't tell you is that there's third party money managers that they put your money with, and there's no way of calculating what kind of fee, so you can pretty much add 1 to 1.5% to that. So you could be in a situation where you have your money managed, and you could be forking out 2 to 4% a year. So then how much money do you have to earn on your retirement investment to net 4, 5, or 6%? You'd have to earn, 7, 8, 9, 10% sometimes. So if you put your money with mutual funds, your typical mutual fund is 1%. plus any miscellaneous trading fees that, again, it's hard to estimate. So what I did is I went over here to, just to give you a perspective, bankrate.com, went under their calculator, and I did 16 years, $20,000 a year, and I said a rate of return of 6% annually. Now, you know, and I know the stock market isn't going to give you 6% every year. Some years are going to be higher, some years it's going to be lower, some years it's going to be 20%, 30% in the toilet. Who knows? But there's no way of predicting. And these averages really aren't that accurate. So I'm just being generous because remember, to get 6% in the scenario I just gave you, you really have to make 8 or 9%. That's a good year in the market when you're looking at an average. Don't have to worry about this because I factor this in, as this assumes you have a tax-deferred investment and a return of 6%. So we're not taking any taxes. Now, if someone were to decide, I'm just going to, have a stock market account and I'm going to grow my money as much as possible, well, good luck with that, because if your investment earnings were taxable at a combined marginal rate of 29.5, your ending balance would be 488. And after taxes and 2.9% annual inflation, your total would be further reduced to 305. So you'll get chopped to pieces if you invest money long term in a taxable account. Let's put it that way. So, but anyway, based on 16 years, $20,000 a year, and no taxes, you're at $564,258 a year. Not a year, but total. So you've saved your money all that time. You end up with $564. Taxable is $484, and include inflation, $305. So you're at $564. So someone says, well, Victor, I don't care about this whole life thing. I'm going to put my money, in an IRA and put it in the market. Okay, great. Let's go for it. You're looking at $564, and this is being generous, right? Including all fees, net 6% a year. Pretty darn good. $564. Well, the experts say you should not take any more than 4% out of that account. Well, if you take 4% of $564,258, you end up with $22,570 before taxes. Well, $22,570, you're about right here. But this is tax-free. The $22,570 on the other example is before taxes. So if you're going to spend the next 16 years worrying about what the market is going to do, stressing out over that, and end up with less net income than just putting your money in an infinite banking policy, which one are you going to do? We can play scenarios like this all day long. And people say, well, the market is great, and this, that, and the other, and long-term this. And look, we have no idea. Even with Trump as president, the stock market is going gangbusters. We have no idea. And Trump is not going to be president forever. So who knows what the market is going to be 10 years from now. But I tell you this, I can look at history. And if I go back over here to the S&P 500. Now, I was fully licensed as a financial advisor, an investment manager, and all during this time. I want you to see something. This is the S&P 500. This is the most popular index people follow other than the Dow Jones. You see this? The year 2000. The market's up here. Then we had a recession. 2001, 2002, 2003. You see the years right here at the bottom? Look where we're at, way down here. Then we start crawling out. I remember getting downsized from my job right here, going into house flipping. Did house flipping for 2 years, made a ton of money, and all of a sudden, mortgage crisis hits, real estate crisis hits, banking crisis hit, my business gets wiped out along with a bunch of other builders and everybody. And look at here. And the market hits rock bottom, the beginning of 2009, and it starts to crawl up. And here you are at the beginning of 2010. Look where we're at. But, wait a minute, let's go back 10 years. The market's up here. 10 years of your life putting money away, and look where the stock market is. That's why they call this the lost decade. You went nowhere. But guess what? What if you had your money in an infinite banking policy during this whole time? Your cash value would be way up here at that time. So, will this be repeated again? I don't know. What I do know is that this century has completely changed the stock market forever. You just don't know what's going to happen. That's why I got out of the securities world, and that's why I do infinite banking and only fixed annuities. Fixed index annuities. Because if you'd have been in a fixed index annuity, you wouldn't have had any cost whatsoever coming out. And if you had your index annuity tied to the S&P, your account wouldn't have gone down. You just wouldn't have been accredited into any interest here. It would have gone down again. And the index would have gone down again, but you would have never lost a dime in your fixed index. Your account would have just stayed the same with no cost coming out of it. See? While everybody's climbing out of the hole, you're adding to your earnings in a fixed annuity. Then the market tanks, your fixed annuity stays right up here where it was. And then it resets down here, and when everybody's climbing out of the hole, you're adding to your income, you're adding to your assets with a fixed index annuity. So again, if you'd have been in a fixed index annuity, you'd be way up here where my name Victor is, where everybody else is still in the hole. Same thing with whole life. You'd have been way up here. That's why the thing I do for retirements anymore is fixed index annuities and infinite banking. So I just wanted I wanted to show you this to give you a perspective, because you'll hear people out there that don't know any better, like the Dave Ramseys of the world, saying, oh, whole life is a bad place to put your money for long term. Nothing could be further from the truth. It's ludicrous to even make a statement like that. So here we go. This is a conservative investment. Really, we don't want to call it an investment so much. It is a life insurance policy. Lawfully, technically a life insurance policy with cash accumulation. But it's conservative. But it's steady every year, year in, year out. It's going to make money no matter what. Whereas the market, you have no idea what it's going to do. So when you're looking at 20, 30 years down the road, what I'm telling people is you need to have the bulk of your retirement money in something like this, or a fixed indexed annuity, and put some of your money other places like real estate, or if you want to educate yourself and dive into the market and just pick out one or two stocks and just invest in them, buy them low, sell them high, buy them low, sell them high, go for it. But you need to educate it. You need to manage that. Don't give all your money to an investment advisor and say, hey, take care of this for the next 20 or 30 years, because he's not going to do as good as the S&P 500, which you can see can be pretty bad sometimes, and he's not going to beat this. He's not, because this is going to pay out tax-free one day. Plus, along the way, you can use it to borrow from, because you've got all this cash accumulation going on here. 16,000, 33,000, 52, 94. You get to year 10, you get $222,000 that you can borrow from to do whatever you need to invest in whatever you need to, while your cash value continues to grow unhindered. So that, I'm just giving you an idea of why I even do infinite banking, why this is what I like to talk to people about, why I can look at this 10 years from now and not have any regrets and not be sorry that I put a client in infinite banking, or I recommended that a client do infinite banking, because I know the client isn't going to be hurt. I know the client's going to have money. I know they can't lose the money. I know the client's going to get to retirement and have some money. So anyway, we're not sitting there literally. I mean, let's look at this real quick. What if you'd have been here 2007 and decided, okay, I'm 68 years old. It's time for me to start drawing money for my retirement. Bam. There's your nest egg. Guess what? Your retirement is toast. Now remember, we said $564,000 the conventional way. Okay. So now you're going to draw 4%, right? You're $22,570 before taxes. But, guess what your account just did? Well, I had only 50% in the market there. The rest in bonds. Bonds went in the toilet too. And let's suppose your retirement, your $565,000 doesn't go all the way down here, but it does drop to $400,000. And now you're going to draw your $22,000 out? Right now you're sweating, thinking, oh my goodness. My retirement nest egg. If I draw $22,000, how am I going to make it up? Maybe I won't draw anything. Maybe I'll just draw $5,000 and go back to work. You know what I mean? This is what I'm trying to impress on people. I'm not saying you need to put every penny you have in infinite banking, but you need to look into your future and see what you want to do, and see, and the bulk of your retirement money that you're saying, this is going to be what I'm going to live off of sometime, the bulk of it needs to be in something, either a fixed index annuity or an infinite banking policy, or both. All right. So that's putting in $20,000 a year for 16 years. MEC limit of $38,000. Death benefit starting out at $587,230. And then you're 71 years old, you take an income for life, tax-free. Obviously, if you put more than $20,000 in during these years, all these numbers are going to be larger. The number you end up after 16 years is going to be larger. Your income is going to be larger. But this just gives you an idea how it works. Now let's go to the next illustration. The same thing, but here we just have it reduced paid up. And you might say, I don't need the income, or I'll hold off on the income. And you let that cash accumulation keep going. So it's still the same thing, $422,450, but you go reduce paid up. Your death benefit goes to $702. It's a little higher because you didn't draw any income out. And here's your cash values jumping up, 437, 463, 590, 618, like that. And you get to age 80 and you say, okay, I'll start drawing income. Obviously, from 677,000, your income is going to be quite high, a lot higher than the 22,000 you saw on the previous page. But this gives you an idea. If you don't touch it, and all you do is $20,000 for the next 16 years, go to reduce paid up, no cost anymore, and the policy just keeps going. Heck, you could decide you never touch it. I'm going to leave it for long-term care if I need it. You die at age 90, you leave $1.1 million tax-free behind, 95.3, like that. Everything's the same. This one here is, what if you just put 20,000 into your age 65 for 11 years and you stop? Then you draw income out. Then it's down to $12,299, obviously, because you don't have quite as much cash accumulation, but you kind of you have an idea of just another 5 years, the difference another 5 years would make. Almost doubles your income. But that's just money contributing for the next 11 years. This is contributing 11 years, $20,000 a year. MEC limit the same, of course. Going to reduce paid up, not taking any income, and just letting that thing ride, and you're done. You've got a life insurance policy for life. You got cash accumulation for life. Now remember, when you go reduce paid up, you can't add any more to it. So if you get to 65 and you want the option to be able to contribute more in the future, then this right here, this base policy 2731, that would start coming out of your policy values, 2791. I mean, just the dividends alone easily pays that, much less the dividends and income and interest. So the policy can sustain itself easily, no problem. And then, if you're still very active at 66 as far as businesses and real estate or whatever, and you want to leave this available to just drop money into, don't go reduce paid up. Just stop making your premium payments, and goes from there. Now, one thing I want you to see is this column. I've gone back to the first illustration. You see this column here? This is this is a term rider. And we need to put that in there so we can put in as much cash value as possible in the first few years. Term rider goes for 7 years, and then we just drop it. This won't happen automatically, but we'll just put it in your calendar or make plans that after year 7 we'll call in and drop that term rider, and then gives you a little bit more flexibility. This reduces the cost a little bit. These term riders aren't very expensive at all. Here's a renewable term rider here, and it's like $14 a month, to maintain this rider. So it doesn't affect the cost, but it is some cost, and it falls off. You can see that the cost, the term rider reduces as the cash value in the policy and the death benefit goes up, then the term rider goes down. And if we left it like this, it might go for another 10 or 15 years before it completely drops off. But we're dropping it off in the illustration here. We're showing it that you cut it off after year 7. And that's that. Well, I think that covers everything. Gives you a good idea of not only how it works with $20,000 a year and the flexibility you have to add an extra $18,000, but kind of gives you some perspective when compared to investing in the stock market and drawing money at it, and how you would draw money from the stock market and taxation and things like that. It gives you a better appreciation of the advantages. And remember, if you put money in a brokerage account and you want to borrow from it, there's a whole different world with that. They take the money out of the market. They have to put it in a fixed instrument, earning nothing, like a money market, to protect their collateral. And here, when you borrow, the money comes from the insurance company's general fund. Your cash value stays the same. It's not affected. It continues to grow without being affected at all by the loan. So that's another major advantage to warehousing your wealth in a infinite banking policy, because the loan, the way you can borrow from it, is so much better than if you are using a brokerage account to borrow from. Okay, that's it. All right, again, this is Victor, and I'll be talking to you guys soon. Take care.